I want you to picture calling a private event venue to confirm a routine expense receipt, only to be told, politely, that they have no record of any reservation on the date in question for an $11,000 client dinner that had already been reimbursed, approved, and closed out 3 months earlier. It's the kind of moment that could mean nothing at all: a scheduling system error, a booking made under a different name, a perfectly boring explanation waiting on the other end of one more phone call. Or it could mean something else entirely, and the only way to know which is to keep asking questions until the paperwork and reality either agree with each other or they don't. This is the story of Yasmin Delgado, an expense compliance auditor who made one routine confirmation call and ended up unraveling a scheme that had been running quietly for 4 years. Yasmin Delgado was 31 years old, and she'd worked as a travel and expense compliance auditor at Castellan Global Partners, a mid-sized management consulting firm, for just over 3 years. Her job was to review expense reports above a certain dollar threshold before final reimbursement, checking receipts against policy limits, verifying that claimed business purposes matched actual client engagements, and occasionally making confirmation calls to vendors on larger entertainment expenses, a standard control most companies use sparingly, mostly for the largest and least ordinary claims. Her department's senior vice president was a man named Douglas Hensley, 55, head of client development, whose entire professional identity was built around relationship building, expensive dinners, private event spaces, the kind of high-touch client entertainment that consulting firms rely on to keep major accounts loyal. Douglas's expense reports were consistently the largest in the department and consistently approved without much scrutiny because client entertainment at his level was simply understood to be expensive, and because Douglas himself had final sign-off on his own direct reports expenses, which meant relatively few people above him ever looked closely at his. Yasmin's first 2 years, she had no particular reason to look closely at Douglas's reports specifically. Client entertainment expenses in consulting are genuinely large and genuinely variable, and a senior executive billing 5-figure amounts for a major client dinner wasn't itself unusual. If anything, she'd respected Douglas during those first 2 years in the ordinary way junior staff respect a senior executive who seems to actually deliver. His client accounts were famously loyal. Renewal rates in his book of business were the best in the firm, and partners several levels above him regularly credited his relationship-building skills as the reason certain major clients had stayed with Castellan through multiple economic downturns when competitors were losing similar accounts. It was during her 3rd year that she made a routine confirmation call on an unusually large entertainment expense, $11,000, billed to a private event venue called the Wharfside Room, for what the expense report described as a client appreciation dinner for a major account. The venue's events coordinator, checking their booking system while Yasmin waited on the phone, told her there was no record of any event under that name or date. Yasmin assumed it was simply a booking system error on the venue's side, and asked whether perhaps the reservation had been made under a different name. It hadn't. There was no event at all that evening at that venue, according to their own records. She flagged it as a documentation discrepancy rather than an accusation, the same low-key correction request she sent regularly for far more mundane reasons. Douglas responded personally, quickly, with an explanation that sounded plausible enough. That event was actually held in a private section they don't track in the eye, our main booking system, arranged directly through the owner. I'll get you updated documentation. A revised, signed confirmation letter arrived within 2 days, on venue letterhead, and Yasmin let the matter close. But the itch didn't fully leave her, and a few months later, reviewing another large entertainment expense from Douglas at the same venue, she decided to check something she hadn't thought to check the first time: the actual ownership of the Wharfside Room. A basic business registration search showed the venue was held by an LLC, formed 5 years earlier. The LLC's registered managing member was a name she didn't immediately recognize, but the LLC's mailing address, when she looked it up separately, matched a property that public tax records showed was owned by a family trust. A trust whose name once she read it carefully, was built from Douglas Hensley's own children's names. That was the moment she stopped assuming clerical confusion and started keeping a quiet file of her own. The same instinct that seems to overtake anyone in her position once a pattern stops looking accidental. She pulled every entertainment expense Douglas had submitted for the Wharfside room over the previous 3 years and began cross-referencing them, one by one, against the venue's actual booking confirmations, requesting them under the routine authority she already had as an auditor, rather than raising any alarm about why she wanted them. There was one afternoon, several weeks into this quiet review, when Douglas stopped by her desk to ask about an unrelated expense report she'd flagged for a different employee. He glanced, briefly, at the folder of venue confirmations sitting on her desk, and asked, in the same easy tone he used for everything, whether she was working on his quarterly summary. "Just routine vendor documentation," she said, sliding the folder slightly closer to herself, without making it obvious. He nodded and moved on, apparently unbothered, and Yasmin sat still for a moment afterward, aware of how close that had felt, even though nothing about the moment had actually given anything away. Around that same time, she mentioned the situation in careful generalities to a former colleague who now worked in forensic accounting, someone who understood exactly how this kind of related party scheme typically got missed for years. "The reason these things survive so long," her friend told her over coffee, "is that nobody wants to be the person who accuses a top performer of fraud based on a documentation gap. You need something that isn't just paperwork against paperwork. You need an outside, independent source, the venue itself, ideally, confirming what actually happened or didn't." That distinction shaped exactly how Yasmin built the rest of her case, leaning as heavily as she could on the venue's own operational records, rather than anything Douglas's office had produced. The pattern, once she'd built it out, was substantial. Of 31 separate entertainment expenses billed to the Wharfside room over 3 years, totaling just under $190,000, only 11 had any matching confirmed booking in the venue's actual events calendar. 20 had been billed, reimbursed, and closed out for events that, according to the venue's own operational records, had simply never taken place. She noticed something else while building the comparison, almost as an aside at first. The fabricated events clustered noticeably around specific times of year, heavily weighted toward the final 2 weeks of each fiscal quarter, exactly when department budget spending needed to look fully utilized to justify the following quarter's allocation, and exactly when year-end bonus calculations for senior client development roles were finalized based partly on documented client engagement activity. It wasn't just free money. It was money timed specifically to make Douglas's performance metrics look stronger at the exact moment as those metrics mattered most for his own compensation. She calculated what that timing pattern actually meant in practice. In 6 of the 12 quarters she reviewed, the fabricated entertainment expenses alone accounted for enough documented client engagement activity to meaningfully improve the department's quarterly performance dashboard, the same dashboard that fed directly into Douglas's own bonus calculation formula. He hadn't just been pocketing reimbursement money, he'd been using fictional client dinners to inflate the very numbers that determined how much he got paid on top of his base salary. She sat with that number for several days, understanding clearly what she was looking at, and equally clearly how carefully she needed to handle it. Douglas wasn't merely inflating real expenses. He appeared to be billing the company for entirely fictional client dinners at a venue his own family trust owned, effectively paying himself directly out of company funds disguised as ordinary client entertainment. She requested a meeting with the firm's chief financial officer directly, a woman named Renee Okonkwo, sending one careful message: "I've identified a documented pattern of entertainment expenses billed for events that did not take place, tied to a venue with an undisclosed ownership connection to a senior executive. I have the venue's own records confirming this. I'd like 15 minutes today." Renee met with her within the hour. Yasmin laid out the file precisely, the confirmed versus billed comparison first, since it was the most objective evidence, then the ownership trail connecting the venue to Douglas's family trust, framed with care. I want to be clear about what the venue's records show versus what I'm inferring about intent. I can prove 20 of 31 billed events have no matching booking. I can prove the venue is owned by a trust bearing Douglas's children's names. I can't prove where the reimbursed money actually went after that. I think that's a question for people with subpoena authority, not me. Renee read through the comparison slowly, asking specifically how Yasmin had obtained the venue's confirmations without alerting Douglas to what she was investigating. Routine vendor documentation requests, Yasmin said. Nothing outside what my role normally does. Renee nodded, apparently satisfied that the evidence itself was clean, regardless of how carefully it needed to be handled from here. You did exactly the right thing bringing this to me directly, Renee said, closing the folder. Don't discuss this with Douglas or anyone on his team. I need 48 hours before anything moves. Renee didn't wait the full 48 hours in the end. She brought in outside counsel that same day, given the clear indication of both expense fraud and an undisclosed related party financial interest. Within a week, banking records obtained through counsel confirmed that reimbursement payments for the fabricated events had been deposited into an account controlled by the same family trust, essentially completing a loop where company money left as an expense reimbursement and returned, quietly, as personal income. The investigation also found that a handful of the 11 confirmed events, the ones that had actually taken place at the venue, had been billed at inflated amounts well above what the venue's own records showed the actual cost had been, meaning even the real dinners had been quietly padded on top of the entirely fabricated ones. It wasn't just a scheme of invented events. It was invention layered on top of routine inflation, refined over years to the point where even a genuine, verifiable dinner still generated extra, undetected profit on its way through the reimbursement system. Douglas Hensley was placed on administrative leave within days of Renee's review beginning. The leave became a termination within 2 weeks, followed by a referral to legal for civil recovery of the fabricated portion of the expenses, and separately, given the scale and duration of the fraud, a referral to outside authorities for review. Yasmin was, in the aftermath, credited clearly and specifically for the discovery. Renee made a point of noting to the executive committee that the entire matter surfaced because one auditor had made a single unglamorous confirmation phone call that policy allowed but didn't strictly require, and had trusted what the venue actually told her over a smooth, quickly produced explanation from a senior executive. She was given expanded authority to conduct routine, randomized vendor confirmation calls on any large entertainment expense across the firm, a control that had technically existed in policy for years, but had rarely been used with any real consistency before her discovery made clear exactly why it mattered. Some weeks later, training a new auditor on the updated confirmation process, Yasmin found herself explaining why even a perfectly formatted receipt on real letterhead with a real signature wasn't the same thing as proof that something actually happened. Paper can say anything someone wants it to say, she said. The only thing that actually tells you the truth is calling the place the money supposedly went to and asking whether it happened. It took one phone call to unravel 4 years of this. Most fraud doesn't survive someone actually asking the other side of the transaction. The new auditor asked, reasonably, whether making that call on every large expense wasn't going to slow the reimbursement process down considerably for the vast majority of entertainment expenses that were completely legitimate. It will, a little, Yasmin said, but the alternative is trusting a signature on a page, and we already know exactly how long that trust can be quietly taken advantage of before anyone notices. A few extra minutes on a phone call is a small price for making sure the paper and reality actually agree with each other. If you've ever had a routine check turn up an answer that didn't match the paperwork in front of you and felt tempted to assume it was just an administrative mix-up, make the second call anyway. The paperwork is only ever as honest as the person who filed it, and the people most confident that nobody would ever bother checking are usually the ones with the most reason to worry if someone finally did. Keep your file. Keep your receipts. Sometimes the truth is one phone call away, and nobody had bothered to make it yet.